Okay, so let's figure out the journal entry. Let's see if you. So we figured out the answer to this question. Now let's do something else. Let's think about the journal entry that would relate to this this stock dividend. So let's say, well, we still got 60,000 shares outstanding before the stock dividend, and now let's just, it's not this this information isn't in the problem, but let's just say each share is valued at $1 each. So before the stock dividend, our common stock is worth, or the value is $60,000. After the stock dividend, we increased the number of shares to $66,000. We've still got $1 each, so therefore the total value is $66,000. Now what happened? Well, we increased the value of our common stock by $6,000. We can do that. The journal entry that would relate to that is a credit to common stock for $6,000. And then we take out of our retained earnings account $6,000. There's our journal entry. Debit retained earnings, credit common stock for the value. And as we said before, a stock dividend has no change on stockholders' equity because we're increasing common stock and decreasing retained earnings by the same amount. These are both equity accounts, so increasing equity and decreasing equity by $6,000, no net change. We can also talk about a stock split. That was on a previous question. The journal entry for a stock split, there is no journal entry. So if they ask a question like that, no journal entry for stock splits. No matter if they're 2 for 1, 3 for 1, whatever. Okay, moving on. We've now gone on to statement of cash flows, which I'm sure you guys know is a behemoth. I believe this should be the same information. Let's see. Let's hope so. So, set up my cash T account. Break it into the thirds. We've got our operating section. That's going to include our current assets and current liabilities, as well as our depreciation expense and any gains and losses on our income statement. Our investing is going to be, or is going to include any long-term assets. For example, equipment, land, buildings, any long-term assets. And then our financing section includes any long-term liabilities and anything from stockholders' equity. So things like bonds payable or notes payable or common stock, dividends, anything from those two. So there we go. So we'll take a look at our information here. I've written down a bunch of stuff. Just ignore that. First step is to go to the income statement. Here we go. Get the net income, $1910. Net income is $1910. That's in or the very top of the cash flow statement in our operating section on the debit side. From here on out, we're going to be adjusting our net income. So there's our first step, net income. Second step is to grab any non-cash expenses. A non-cash expense is depreciation expense. We've got $150 in depreciation expense. We're going to add that back. Depreciation expense for $150 in our operating section. Next step is to look for any gains and losses. We've got a gain right here for 60. We subtract our gains, we add our losses. So we've got a $60 gain. We're going to credit that because we're subtracting our gains. Okay, that's pretty much the first 2 or 3 steps. Next step is to go over the supplemental information and do the journal entries for those. So, number 1, we sold equipment for some cash, and we had some depreciation. So if we sold equipment, that means we credited equipment for its original value, which is $600. We got cash for $300, so we're going to debit cash for $300, and we had accumulated depreciation of $360. To get rid of our accumulated depreciation, we would have debited accumulated depreciation by $360. Therefore, we had a gain for $60. There we go. There's our first journal entry. Number 2, we issued a bond at par for $1,000 cash. So if we issue it at par, then we're getting $1,000 cash, and we're also setting up a bonds payable for $1,000. There we go. No discount or premium. Number 3, we purchase equipment by signing a note payable for $1,000. So if we purchase equipment, that's a debit to equipment for $1,000, and we used a note payable, so we're going to credit note payable by $1,000. Number 4, we issued some stock for $1.75 per share. Just to point out, we've got common stock with $1 par and some additional paid in capital. So we know that our par is at $1. How much cash did we get? Well, if we issued 1,000 shares for $1.75 per share, that means we got $1,750 in cash. It's a debit to cash. We're going to credit our common stock at par for the dollar par times the number of shares, so $1,000, and then our additional paid in capital for the common stock is the rest of it, $750. There we go. That's number 4. Number 5, we paid a cash dividend of $4,450. That means we debited dividends by $4,450, and we credited cash $4,450. There we go. So there's our 5 journal entries for the supplemental data, and we'll use those to as we look at our T accounts. So going to the balance sheet, for each account, we're going to determine if it's increasing or decreasing, and by how much. So I think the best way to do it is just to do a bunch of T accounts. Start off, we'll begin with accounts receivable. Accounts receivable in 2017, we began with $5,500, and we ended with $4,000 in accounts receivable. We know that's a debit because accounts receivable is a asset, therefore it is naturally a debit. So there we go. Also a tip, be careful of the years. In this case, 2017 is on the left, 2018 is on the right. You know, it's kind of 50%, you know, it could go either way. So 2017 could be on the right and 2018 could be on the left. So just be sure you pay attention to that, because if you don't, you'll get everything wrong. Or, well, Yeah, you'll get everything wrong. Yep, you'll get everything wrong. So, anyway, going back to accounts receivable, we began with 5,500, ended with 4,000. Therefore, we decreased accounts receivable by 1,500. We're debiting accounts receivable. Therefore, we're going to I'm sorry, did I say that backwards? We're crediting accounts receivable. Therefore, credit accounts receivable. Therefore, we're going to debit cash. In which section, you ask? Well, accounts receivable is a current asset, so it's going to be debited in the operating section. So we've got accounts receivable by 1,500. There we go. Moving on to the next one. We've got inventory. So inventory, another asset. We began with 1,800 and ended with 2,900. Yep, 1,800, 900. Therefore, we're debiting, or we're increasing inventory by 1,100. For debiting inventory, we're going to credit cash. And again, which section? Well, inventory is a current asset, so we're going to credit it in the operating section for 1,100 as inventory. The reason we're decreasing cash, and maybe this logic will help you, if we're increasing inventory, that means we're buying inventory. If we're buying inventory, that means we're going to decrease cash. So maybe that'll help you, or maybe that'll just confuse you even more. Anyway, moving on to the next one. We've got equipment. And we started at 1,000 and we ended at 1,400. And I'm also going to do the accumulated depreciation for the equipment as well. We began with 510 and we ended with 300. Be sure to recognize that it says a negative as accumulated depreciation because accumulated depreciation is a contra asset. Accumulated depreciation has a natural credit. Anyway, so there's our equipment and accumulated depreciation, T accounts. Now, we can't just debit equipment by 400 and then credit cash for 400 because that's not what happened. What really happened when we look back to our journal entries is we credited equipment by $600 because we sold some equipment. Credit equipment 600, credit equipment 600. So I'm just going to kind of cross that off a little bit in green. Where else did equipment be affected? There we go. We've got equipment. We purchased equipment, or we debited equipment by 1,000. So there we go. There we go. Got those down. And equipment wasn't affected any way else. So does this T account balance out? Well, we began with 1,000, bought 1,000. So now we've got 2,000, and then we sold 600. Therefore, we're left with 1,400. That checks out, so we're all good. We don't put any of this onto the cash T account because that was what happened to equipment. So we don't affect cash in any way in regards to that. With this equipment journal entries, we can see that we got $300 in cash. So that's something we can do to the T account. We're debiting cash by 300 bucks. So we're going to debit cash somewhere. And in which section? Well, it's going to be our investing section, because this cash is related to equipment. Equipment is a long-term asset, so we're going to increase cash by 300 bucks because we sold equipment. There we go. So we're good there. This accumulated depreciation, we can show where that ended up. I'm sorry, this is a lot of flipping back and forth. Here's our accumulated depreciation T account. We debited accumulated depreciation by 360, so therefore we're going to debit accumulated depreciation by 360. Going back to the journal entries, we can cross that off because we accounted for it. And then lastly, this gain.